Hello everybody, and let me just set the scene for this conversation with a challenging economic landscape in South Africa right now. Fluctuating currency, global trade tensions and ongoing energy struggles. Budget 2025 is a lot more, I would suggest, than numbers on a page. It really is a blueprint. It's a statement about South Africa's short-term economic future. So a very warm welcome to a special edition of No Ordinary Wednesday. It's our budget speech preview, and we are filming it, as you can see, at Investec's Sandton headquarters. And today I'm joined by a panel of experts, the Chief Economist here at Investec, Annabel Bishop, along with Treasury Economist Tertia and Chief Investment Strategist Chris Holdsworth. And the intention of this conversation is to break down the budget and what it's going to mean for business, investors, and I guess most importantly, South Africans at large, you and me. We're going to take a look at government priorities, also how the budget should boost economic growth. That is absolutely critical. Also, while maintaining fiscal consolidation. We'll also touch on tax policy and spending decisions and how that impacts markets. So Annabel, Tertia, Chris, a very warm welcome to this special edition of No Ordinary Wednesday. So Annabel, let me start with you as we prepare for the Minister's upcoming budget speech. Give us a broad sense of the macroeconomic landscape. And to my two other guests, I'll put the same question to you just to get the ball rolling.
Well, South Africa's come from a particularly weak period, and of course last year now it looks like economic growth is going to be around 0.5%, but we've had some positives. We've had a largely resolution to electricity crisis, but of course stops and starts, recent load shedding, and expectations that we could see a few more incidents. However, there's been a lot of progress made, and I think that's probably what you feel is behind the scenes. It hasn't shown up in economic growth yet, whether it's in Transnet or other areas, and of course the sonar outlined that quite clearly. But really for us, we're going to be looking at what are the growth stimulatory measures in the budget, and of course they're likely to be focused on infrastructure. There still will be social welfare support, and of course what's happening around inflation. For South Africa, we're very beholden on the global economy. We're a small open economy, so the start to the year has been filled with uncertainty on the new administration in the US. Looking forwards, we think that we're probably going to still see a tame inflation environment for South Africa, but economic growth picking up over the medium term towards 3%.
So, Chris, what about you? As Annabel is saying, a slightly more benign environment, perhaps?
Yeah, I think the defining characteristic over the past couple of years has been weak growth in South Africa, and that's led to expectations that growth will continue to be weak, despite some of the improvements in the background that Annabel's referred to. And therein lies an opportunity. If you look at consensus forecasts for growth this year, it's between 1.5% and 1.7%, and the year after is just a bit above that. And that puts South Africa in the bottom 20% of countries across the globe. And it shouldn't be hard to beat that. And so even if we see a modest improvement, we are likely to see numbers that come out in excess of expectations. And I think that's sort of what we're waiting for. You don't have to do a lot to be able to beat what we think are close to rock bottom expectations for the SA economy.
Tertia, just before we started taping this podcast, Chris was saying how quickly 2025 has gone along. And if you cast your mind back to October 2024, it was a long time ago. What, in your opinion, has changed since the Minister tabled the medium-term budget policy statement?
Certainly, I think one of the biggest changes has been on the global environment, with Trump now, spearheading the Western economies and exerting his influence around the world. So I think navigating in this kind of environment is becoming more challenging. And there's obviously major risks to growth and inflation depending on what happens to tariffs, uncertainty about that, because that can also influence investment and consumer spending around the world, what is going to happen to global trade, and then a spillover effect for South Africa. But I think, as Annabel and Chris said, the emphasis is then, and the focus is going to be very much on South Africa, because if the global economy becomes more challenging, the global political economy becomes more challenging, we really need to move the needle for South Africa.
And Chris, there's no doubt that whole global uncertainty is going to ratchet up. Of that we have no doubt. I mean, Tertia mentioning tariffs, for instance. So before we tackle the nuts and bolts of the budget, what specifically do you think investors are going to be looking out for?
Typically with the budget, from an investment perspective, there are two key moving parts. It's the debt to GDP trajectory and any changes to tax policy. And any shifts on those are material for both the fixed income market and the equity market. And we can run through some scenarios and the likelihood of any changes, but I would say from a starting point, we would, from an investment perspective, need to focus on those two driving forces.
Let's get to tax in just a moment, but Annabel, one of the key concerns, as has been mentioned, is the deficit. How does the Minister tackle this, and where's the wiggle room here, if there is any?
So, the real problem South Africa is facing is just not enough revenue, not enough profitability coming through, not enough business going on in South Africa, weak economic growth, as you will. And of course, what we're finding in South Africa is over the last several years, in fact, over the past decade and this decade in general, the trend has been for fiscal slippage, a worsening of government finances. And you can see the debt now expected to peak at 75% of GDP. Now, of course, it was worse a few years ago, and it does, vacillate, but it's way up compared to the 50% of GDP or, closer to 30% in previous years, previous decades. So this is the problem for the government. Not much wiggle room in that regard. They did talk today about the medium-term plan. It was announced after the sonar. Interestingly, they said in the announcement I read that they are not looking to put any fiscal expenditure ceilings. So they were talking about them previously, some fiscal rules, but now appear to have drawn back on them. So that appears to give a little bit of wiggle room. They specifically said the reason for that is to be able to deal with some type of crisis if it arises, but that's on the expenditure side. And of course, we're talking about revenue here. So, that result of that trend of fiscal slippage over the past decade, and of course this decade, has really been to see higher borrowing costs, which has resulted in higher bond yields, a weakening in the rand, worries around, and of course downgrading of South Africa's credit ratings. Looking forwards, I think as we move to a fast economic growth environment, that's where the wiggle room is going to come from. If we had around 0.5% last year, we've got 1.8% for this year, and then going above 2% going forwards towards 3%, that will make a big difference. And of course that's what government's counting on to bring these ratios down, whether it's the government debt or fiscal deficit ratios.
Tertia, let's pick up on the debt. We know the challenge looms large. It's going to be very difficult for government to lower its debt trajectory.
No, for sure. I think the best scenario that we're looking at, and the base case scenario, is perhaps for debt to GDP ratio to stabilize at about 75 to 77% of GDP over the medium term. So
Still
the next
very high.
3 years, it is. And that from that perspective, it will be very difficult for us to get to investment grade. But I think what we're hoping for, and this year in a way, we're going to discuss it a little bit later, is a holding year for the budget, while we're waiting for economic growth to kick in the outer years. So from that perspective, taxes are becoming destructive. There's not much that they can do on that side. And on the expenditure side, as Annabel pointed out, there's not much space for them to actually increase spending because we need to consolidate that budget deficit. And a very important point is that, and this is where the confidence factor comes in, is the risk premium on government bond yields, because at the moment the bond yield is above nominal GDP growth, which makes it also difficult to lower that debt to GDP ratio. So there's a couple of moving parts in getting this ratio lower.
Chris, what are your thoughts on driving growth?
Yeah, I think coming back to the starting point, expectations are very low. So I think we don't have to do a lot. If you look, for example, we're talking about the debt to GDP trajectory and how there might be a revenue miss, and we'll end up with 75 to 77. S&P expects 80. And so what we really have to do, what Treasury has to do, is deliver roughly in line what they guided in the medium-term budget policy statement. And in that environment, we would expect to see potential for an upgrade even without improving numbers, if they just stay in the status quo, because the expectation is for deterioration. So just staying where we are is better than expected. And with a rating upgrade would come lower cost of capital, and that would engender faster growth as well. So there's a few moving parts where all we need to do is sort of stabilize, exactly as Tertia said, stop deteriorating, and we should start to see the flywheel spinning, aided by interest rate cuts and a few other factors.
But what sort of message does that send out to the investment community if, as Tertia puts it, it's just we're in a holding pattern?
Well, that's better than expected. I mean, the expected is what is further deterioration. So a holding pattern.
So they would see opportunity in that.
Yeah, if we present numbers that are much better than the rating agencies expect, even though they might be in line with what they were before, that would present it as an opportunity.
So Annabel, just in terms of revenue, you talk about revenue being the key part of this entire equation, but Tertia just mentioned that we've kind of taxed out here. So what kind of tax implications might we see when he delivers this budget? Where does he go? What can he do?
So I think we're not talking about tax for revenue. We're talking about economic growth and organically building revenue. So higher levels of government revenue coming from fast economic growth. And when that happens, you get higher revenue coming in from taxation on VAT, from taxation on companies, personal income tax, customs and excise. All of those occur when your economy is growing at a rate of closer to 3% than it is closer to 0.5%.
Where do you see those growth opportunities?
For the economy, for the revenue. So I think, what we are experiencing at the moment has been very weak economy for past several years, and the expectation that it'll carry on being weak. And that, of course, has a negative impact on business confidence, which is still depressed. I think the surprise or the upside will come when businesses start to realize government has actually delivered more than expected. For example, last year in the sonar, people were saying, well, it seems a bit strange. They're saying they're going to end the electricity crisis very soon. And yet that's what happened. Now in the sonar this year, they're talking about ending the freight crisis quite soon. So all of those factors would start to build towards supporting growth. Remember that the government said, President Ramaphosa himself said that the weakness of the freight sector subtracts 3% from economic growth. Now, what does that mean? That we should be closer to 3.5% to 4%. Now, that would be very surprising for investors, for the business community, for the credit rating agencies. In fact, Jeremy, and this is the key point, when you read what the credit rating agencies actually write, a lot of it centers back on economic growth in South Africa as the resolution to a lot of the issues. So I firmly believe that South Africa is taxed out, as you say. The tax buoyancy ratio cannot really absorb. It shows it cannot absorb more on the tax front. And while we probably are going to have a weakish year this year from a GDP perspective, I think it'll be the year that things start to turn and we start to certainly see strong growth from next year.
So against all odds, as you rightly pointed out, Eskom did come right. Do you have that same degree of optimism as far as freight and logistics are concerned?
The issue with freight and logistics is a lot bigger. It's a lot more complicated. There are more parts to it, whether it's the rail or, of course, the ports, the shipping itself. And while a lot of work has been done in terms of turning around a lot of the governance, there still are issues. If you look at the private sector's concern, for example, on the public-private partnerships, they worry about who's going to pay for the upkeep of the infrastructure. Sure, they'll give the money to government to be able to run their locomotives on the rails, but who's going to pay to upgrade those? The railway system has been damaged infrastructurally over the past few years, and to keep it going. So I think, you have those types of concerns. Big infrastructure spend in many different parts needed, for example, on the cranes and the ports. Yes, we think it is going to come right, but not as quickly. We think that we're going to continue to make traction this year and next year, and in different areas as well. There's a lot in the sonar on water. Another crisis for South Africa, crime and corruption, the key areas that government looks at for the business-government partnership. So we think the wheel's going to continue to turn as opposed to deliver a very spectacular, surprising, instant result. Rather, we expect to see steady traction, resulting in a much stronger and more positive outcome for South Africa, which, let's face it, Jeremy, would be more sustainable.
Tertia, Chris, do you have any thoughts on tax and whether there's going to be any creative thinking in that respect?
When you look at the previous budget projections, what has become a very easy source of revenue is fiscal drag. So when you get a salary increase, you go into the next tax bracket and the brackets don't get adjusted. And that generates like nearly 16 billion rand per annum. So that's in the baseline forecast for the coming year as well. The problem is it's becoming very damaging to household balance sheets, right? So the question is, will they keep that number as is, or will there be a bit of alleviation? I think the second one is the usual one, is the sin taxes. But I think as far as a wealth tax is concerned, very unlikely. That's too complicated. Important question is, what if the social relief of distress grant will become permanent, which we will see, but there will have to be a financing source for it. There is money set aside for the next 2 years, but looking ahead, so I'm not sure that we're there yet. So for this year, we don't expect any major announcements.
Chris, from an investment perspective, and please feel free if you want to add something to the tax answer, but from an investment perspective, what implications are you seeing for various sectors and the equity market.
I'm just going to start with the follow-on from Tertia on the tax side of things. It won't move the bottom line materially, but we would expect to see some clarity around how trades for collective investment schemes are going to be taxed. So at that point, it will have implications for the asset management industry, but it's not going to have implications for broader revenue. I don't think it will be a significant enough sum in that regard. With regards to sectors in equity market, because we're not expecting material changes to tax policy, we're not expecting material consequences within the equity market as a result of the budget. I think the focus is more likely to be on the fixed income side of things and debate around potential for upgrades and when we could potentially land up in investment grade. But from an equity market perspective, we're not expecting a material reaction. And it's often been the case over time that equity markets in particular, have not reacted materially to the budget. It's often that you'll see the interest in the equity side of things or fixed income. So our focus is not directly on equity reactions, more from fixed income and the currency.
And Tertia, very quickly, what about government bond yields?
Yeah, so that's a very interesting dynamic that's going to fold out. Just quickly, we have seen bond yields re-rating in the second half of last year. So the question is there further re-rating in the coming year? We don't think so, because this is where the growth discussion is coming in. But I think, as Chris also put out, if it's like a holding pattern, that will certainly start building up confidence. But I think from external perspective, obviously US policy is going to be critical. What's going to happen to their budget deficit going forward, which will influence the 10-year Treasury yield there. In South Africa, the direction of inflation is going to be quite important. We think that can hold, sub 3.5% the first half, and perhaps just between 4% or so in the second half. So I think that's still broadly supportive of bond yields, but we see bond yields more consolidating. Also watching what government is going to announce around bond supply, which we expect to remain unchanged. But for bond yields to rally meaningfully further, we really need foreign buyers to come in, and that is where the investment grade rating becomes quite important.
All right, this is a new one for No Ordinary Wednesday. I'm going to ambush the three of you slightly. See the look on your faces, all right? We've got some questions sent in from listeners via our Investec Focus Radio broadcast channel on Instagram. Chris, I'm going to start with you, if that's okay.
Great.
All right. So when it comes to our credit rating, is this question, where do you think South Africa, or when do you think South Africa is going to be able to move beyond junk status?
Okay. If you look at rating agencies, depending on the one that you look at, we are 2 to 3 rungs below investment grade at this point. So really the question is, when are we likely to be upgraded by 2 to 3 times? Now, let's assume Tertia's base case for this year pans out. We're sort of treading water. Because expectations were for much worse than that, I think that justifies 1 upgrade. So you're still left with 1 to 2. When are we going to see 1 to 2? And for that extra 1 to 2 upgrades, you need Annabel's scenario about growth trending towards 3% to pan out. And that pans out over, say, 3 years. So I think realistically, we're looking at about 3 years for us to get back to investment grade, but we have to understand that there is some uncertainty around that. At the moment, we're basing this on growth getting back to 3%. It could happen. We hope it's going to happen, but we could have a recession in that period. So we don't want to be too precise, but I think 3 years as a base case is a reasonable starting point.
Tertia, we're recording this conversation a day after the State of the Nation address, where President Ramaphosa did spend some time talking about unemployment in South Africa. The question is, how can the budget address issues related to retrenchment and unemployment?
So what was very interesting in SONA, and the President also announced it in SONA 2024. Previously the ANC believed we had a developmental state and that the state is the creator of jobs. Now, for the first time last year, he talked about growth is driving jobs. And this is where a lot of researchers indicated we need 5% growth to get more jobs created. And I think, so what can the budget do in terms of creating jobs? Not much. It must create that enabling environment for the private sector, and it comes back to the whole growth discussion. The other issues that obviously are there are a few jobs programs in the budget, and the President also said it created like 2.5 million jobs. So I think that the programs will not change. We are going to continue with the social relief of distress grants because it is a crisis in South Africa. So what we hope is that there will be marginal changes in coming years where the ability of the private sector to absorb jobs can change. But ultimately it is a growth, and you can also add it's a skill story that's playing out in the education side, and that's a grave concern for us as well.
And Annabel Bishop, a question for you. We spoke a little earlier about Eskom and Transnet and also water. The question is, are there strategies that government can implement to ensure the development of a sustainable infrastructure in South Africa?
Yes, interestingly, that was part of the announcements that came through yesterday and today, a slew of announcements. Look, we're going to be waiting for the actual fleshing out of this medium-term plan, where there is expected to be, or they certainly said there's going to be, coordination across the different ministries. And I think that's something which has been lacking in the past. But certainly over the last several years, there's been talk exactly what you said, a proper plan, a coordination of infrastructure. The problem is issues at the infrastructure itself, at Transnet, for example, the different areas of Transnet, that's almost more macroeconomic in a way. You need to get the management right, the governance right, the regulation right. Private sector investors need to know what is the risk and reward. So there still are those outstandings. It's not only about plans and obviously, clarity. If we look at water, for example, they've got good plans. They've got a good framework for when they're looking to bring the Lesotho Highlands project on the next stage to Gauteng, for example, to help us. But then it comes back to the macroeconomics. Often the problem is the pipes wearing out in different areas. So I would say to you rather it's a bit of both. And, that's really the issue in South Africa. Investors are going to be looking at that very heavily in terms of infrastructure because how it leads on to economic growth in South Africa. Will it really result in this 3% or more economic outturn? And of course that's very important for our currency, and of course also as well for investors in our different markets, whether it's equities or bonds. The bottom line is investors need to actually believe we're going to achieve fast economic growth rates after really seeing disappointment for such a long period.
And Annabel, before we close the pipes on this discussion, and a question to all three of you, what's the one big thing that you're looking out for in Budget 2025? Just one.
The same thing I look at every time when I open the book is what's the debt to GDP ratio. It just informs the entire rest of the analysis. But yes, that is, what we do look for. But I know we're only supposed to say one, but again, more clarity around inflation targeting also.
Okay. Chris, what about you?
I have to echo it. It's the debt to GDP trajectory. Above all else, that's what matters for the fixed income market and indirectly for the equity market too. So that would be the primary focus.
Tertia?
I'll go a bit more micro because both Annabel and Chris raised important issues, but I want to see announcements around how the municipalities are going to be fixed, because that's the engine of growth ultimately. And then the other one, I want to see what's happening at Transnet.
Less broken pipes. Couldn't have said it better. Annabel Bishop, Tertia Jacobs, Chris Holdsworth, thank you for joining me on this special edition of No Ordinary Wednesday.